I wanted to give an update. Adam, Pam, myself, and some others from our leadership team went to the AAPL conference. That's the American Association of Private Lenders. They meet once a year in Vegas. That's the unfortunate part. But we spent a couple days there with other industry people. There's about 1,300, 1,400 folks there. Not a lot of private lenders belong to the group because it costs a lot of money to belong, but we find it extremely beneficial. And I'll tell you at the end of this kind of some of the things we're doing as a result of what we confirmed. We thought we knew it, but we confirmed at AAPL. But a couple things I just think are really interesting. Of the home sales that are happening now, 30% of the home sales across the nation are brand new home construction. It's usually less than half of that. It's just that nobody is selling their houses because they have this existing lock-in with a low interest rate. In fact, in Oregon, over half the loans given out are at a 4% or less interest rate. So you can see why those folks that are ready to move up are looking and go, well, gosh, I have a 4% interest rate, I could get 8. So not only have the prices gone up, but the interest rate's gone up. So the affordability index in 2023 is as small as it ever has been in the recent past. The one thing, however, we're starting to see, and we're hearing from others around the country, is that the rate shock is kind of wearing off. It's like a new generation, new span of buyers is coming in, and they're going, yeah, rates are 7% or whatever. They didn't see those 3s and 4s, so that's a good thing. A last little tidbit, which I thought was really interesting, is that 40% of the homes in the United States are free and clear. In other words, 40% of the homes don't have a mortgage at all. Now, that information doesn't affect us directly in private money, but it does because that's people moving around. Some of our borrowers do fix and flips, that type of thing, and so it really does affect our business. A couple things that we came away with is that in the past, we've done loans in probably 7 different states. We've looked at those, Adam and I and Pam, and we said, you know what, we're going to hone that down. We're going to become specialists in Oregon and Washington, and ironically, Texas. We do a lot of business in Texas. So we now lend in Oregon, Washington, Texas. We don't lend in other states. That lets us go deep, really understand those markets, understand the regulation. So rather than be generalist, where we do all over the country, we do those 3 states. The other thing we're doing is we're shrinking the asset classes we'll do. For instance, we've always done commercial, and we still do commercial, but specialty commercial like a car wash, a bowling alley, a restaurant, a gas station that are very narrow and focused, and if we had to take them back, heaven forbid, in foreclosure, they'd be hard to get. While we may loan on them, we're requiring a huge down payment, essentially putting us out of that business. So we're getting narrower on what we're doing and more focused on different states. The downside for investors, there really isn't one other than we may not be able to get your money as working for you as fast as you can because we're turning a lot of loans down that we don't like. Right now, however, as I'm recording this in the early December, there is no wait to get your money working in the Oregon Fund, the PAC-1 Fund, that type of thing. So that would be the only downside, is that we have a few less loans. The good side is they're better loans, they're in areas we know better, we can watch the collateral better, etc. So hope everybody has a great holiday season. Talk to you soon.